Hi, everyone. It is David and Andrew here from FTC. And as part of our professional obligations as tax advisors, we need to stay up to date with the latest tax news and updates. And one of the ways that we do that is subscribing to Tax Banter, which is a great training resource which provides monthly tax updates. And in today's session, we thought we would share some of the insights that may impact our clients. So, one of the things that Tax Banter looked at in this month's training session was a mid-year economic fiscal outlook for 2023 to 2024, which looks at what is happening to our economy in the next year and what are the potential changes. So within this report, which was released in December 2023, it includes certain proposals or changes. So the first one looks at the modification of the foreign resident capital gains withholding. Basically, if you're a foreign investor and you want to dispose of an Australian asset, you may face higher withholding tax. And this is from the increase in the withholding rate from 12.5% to 15%, and the reduction of the purchase price threshold from 750K to nil. So basically capturing every single transaction, which is crazy. Andrew, what do you think about that?
Look, I think the government's definitely trying to tackle the housing supply issue and trying to limit foreign investors, or not limiting them, but charging them more tax to hopefully slow down how much money is flowing in to help local buyers. But yeah, it's going to be a nice windfall for the government if property, say, is $1 million and there's a withholding rate of 15%. That's a good sum of tax for them to collect on the transaction.
Mm-hmm. Definitely. I mean, more revenue for the government, and also hopefully helping the domestic players as well in our economy. So the second point was the denying of deductions for the general interest charge and shortfall interest charge. So if you have a tax debt with the ATO, normally the interest that you incur is deductible. And so what some people have been doing is not really paying their tax debts because it might be cheaper than other commercial debts, and basically utilizing or not really paying off their ATO debt. So potentially if this is not deductible, then it may not actually make sense for you to hold that ATO debt. So if that is you, kind of not paying the ATO, it might be in your best interest to look at refinancing, paying off your ATO debts, because then you may incur these high interest rate charges without a deduction. What do you think about that, Andrew?
So, just to give our listeners a bit of context as well. So, at the moment, especially for businesses or even individuals that incur interest charges from the ATO, usually the following year, that interest is captured and you get a tax deduction. So, what the ATO is basically saying is like, hey, yes, you owe us interest because you're late on your tax debt. However, we're not going to allow that deduction for you anymore. So, this could, especially when it comes to businesses as well, this could be a significant interest charge that's not deductible. So something to keep mindful.
Mm-hmm. And yeah, it definitely makes sense. The ATO wants its money at the end of the day. And, if people are kind of avoiding that because it's seen as a more cheaper form of debt, then perhaps removing it will help the ATO recover its funds. So that's all I really wanted to pick on in this specific slide that may impact our clients. But definitely, if you have any more questions, things like that, please reach out. Hopefully that was useful. And yeah, hope you have a great day. See ya.